If you love dividends, this showdown is for you. Two ETFs are dominating the passive income world right now. JEPI from JP Morgan and SPYI from NEOS. Both pay you every single month, both promise high yields, but one is more tax efficient while the other is more stable. So, which one should you own? Stick around because we are going deep into real numbers, taxes, and total returns that could change how you earn passive income. Let's start with the fundamentals. JEPI, JP Morgan Equity Premium Income ETF, launched May 2020. It's actively managed and aims for high monthly income with lower volatility than S&P 500. SPYI, NEOS S&P 500 High Income ETF, launched in August 2022. It tracks the S&P 500 but adds a smart options overlay to generate income. Both pay monthly but both use options, but the way they earn that income is totally different. Both JEPI and SPYI use what's called a covered call strategy. Here's an easy example. Imagine you own 100 shares of the S&P 500 ETF, SPY, at $500 per share. That's $50,000 total. You sell a 1-month call option with a strike at $510. Someone pays you a premium of $500 for that right. If SPY stays below $510, you keep the premium. If SPY shoots above $510, your upside is capped because you promised to sell at $510. JEPI takes an indirect route. It buys equity-linked notes or ELNs from big banks. Each ELN is basically a bond combined with an options contract. Banks issue them, JEPI buys them, and inside those notes, options are sold on the S&P 500. This structure gives JEPI a steady stream of option premium income, slight downside protection since it owns a lower volatility stocks, and less sensitivity to big market swings. But the trade-off, because of how these notes are built, JEPI's upside is capped. When markets rally strongly, SPYI is more transparent. It directly holds exposure to the S&P 500, usually through futures and treasury bills, and then sells index call options against it. These are known as Section 1256 contracts, and this will matter a lot when we hit the tax section. SPYI's method is like running a covered call directly on the index, not through a middleman like JEPI's ELNs. It's simpler, more flexible, and as we'll see, far more tax efficient. This next part is the single most overlooked yet most important difference between JEPI and SPYI on how they're taxed. JEPI's distributions are mostly classified as ordinary income because of those ELNs. That means they are taxed just like your job salary. Let's say you earn $80,000 per year, which puts you roughly in the 22% federal tax bracket. If JEPI pays you $1,000 in dividends, you'll owe around $220 in taxes. You keep $780. That's before state taxes. So JEPI's after-tax yield in a taxable account could drop from 8.3% to around 6.5% or even lower. SPYI. Now SPYI's secret sauce, the 60-40 rule. Under US tax law, Section 1256 index options are automatically split as 60% long-term capital gains, 40% short-term gains, regardless of how long you held them. So if you're in the same 22% tax bracket and long-term capital gains are taxed at 15%, your blended rate comes out to be 17.8%. That's about 20% less tax on your distributions than JEPI. Plus SPYI sometimes classifies distributions as return on capital, meaning you might owe no tax immediately. It just reduces your cost basis and you pay only when you sell. Let's break this down with an example. Say you invest $10,000 into each ETF. For JEPI, $10,000 at 8.35% will come out to be $835 of annual income or $69.5 a month. For SPYI, $10,000 at 11.77% will come out to $1,177 annual income, which is around $98 per month. That's an extra $28 per month from SPYI or $336 per year difference. Over 5 years, that's nearly $1,700 more cash flow before taxes. Now on expenses, SPYI's fees is almost double JEPI's. But after tax and after yield, often SPYI still comes out ahead, especially for taxable investors. And look at volatility. JEPI's beta of 0.56 means if the S&P 500 drops 10%, JEPI typically falls only about 5.6%. SPYI with a beta of 0.85 might drop around 8.5%. Now, let's look at the performance. Since SPYI launched in August 2022, SPYI's total return is more than 52.9%. JEPI's total return is roughly around 15%. S&P 500 SPYI's total return is more than 34.7%. That's not just a small edge. SPYI destroyed both the S&P and JEPI in this time frame. Why? Bull market recovery. The 2023 to 25 rally helped growth and tech stocks rebound hard. JEPI's defensive portfolio. Its lower volatility holdings like utilities, consumer staples underperformed when market ripped higher. SPYI strategy. SPYI captured most of the upside of the S&P 500 while still pulling in huge monthly premiums. In short, when markets run, SPYI can run with them. JEPI plays defense. SPYI plays offense. Choose JEPI if you want lower volatility and smoother returns. Invest mainly in IRAs, Roth IRAs or 401ks. Prefer a big proven ETF from JP Morgan with massive liquidity. Like defensive positioning, less exposure to tech and more value stocks. You're retired or near retirement and prefer predictability over maximum yield. Example, if you're 65 and relying on monthly income in your IRA, JEPI is a set it and forget it income generator. Choose SPYI if you invest in a taxable account. This is huge. Want the highest yield possible, around 11 to 12%. Are you comfortable with slightly more volatility? Want exposure to the full S&P 500 including tech? Appreciate tax smart distributions and potential long-term compounding. For example, if you're 25, investing smoothly in a taxable brokerage and reinvesting dividends, SPYI lets you compound income faster while deferring taxes. So here's the verdict. JEPI, stability, safety, and lower volatility. Best for retirement accounts. SPYI, high yield, tax smart growth, and bigger upside in bull markets. Best for taxable accounts. Both pay you every month. Both can fit into a dividend portfolio, but the right choice depends on where you hold it and how much risk you're comfortable with. So tell me, which side are you on? Team JEPI or Team SPYI? Drop your pick in the comments. And if this deep dive helped you understand these ETFs better, hit that like button, subscribe to Yieldcraft, and ring the bell for more investing breakdowns.